Good afternoon. It's Tom Aspray with the Viper Report. It's Tuesday, August 24th. Quite a few things in the market have changed since June 7th when I put out this video, and how positive the market internals has just flipped back and gave strong positive signals suggesting a sustainable rally. As we went into June, early July, we had a number of long positions in both ETFs and in stocks. But starting towards the latter part of July, there started to be signs of internal weakness, and therefore we kept taking profits on long positions and reducing our exposure. You can see in July 25th, still time for a market vacation, putting out and suggesting that there was increasing market risk at that point. Since then I noted that consumer sentiment had really dropped. It's often a good barometer of the market. And then just last week I pointed out that global money managers, I think they cover over $700 billion in assets, were getting much more cautious and starting to get nervous. And in my Forbes article, there's a link in the email, I explain why that's a good thing. Here's some of the charts from that report. You can see that economic expectations peaked in March, have turned down. You can see these other peaks here didn't always correlate with a big market decline, but they did suggest a more normal, less euphoric market. Also here, percentage that are expecting a much stronger economy have also dropped. This is all consistent with a market that needs a correction. And of course, everyone's looking for the Jackson Hole meeting on Friday for Powell to suggest they're going to taper, start cutting back their bond purchases. These money managers, if it doesn't happen in Jackson Hole, happens the September meeting or sometime by the end of the quarter. One of the things I've been discussing in my Forbes articles has been the market action versus the advanced decline lines. You can see that here we have the New York Composite, the weekly chart, and below that we have the all advanced decline line. That's everything on the NYSE. You can see it peaked out here in June, started to form lower highs in late July, early August, and showing a negative pattern because the market was making new highs. Made its last new weekly high here. So with data up till yesterday, you can see it's trying to turn higher in the all ID line. It's really got to get above this resistance here, this line C, and above the prior peak to turn positive. Similar down below that, the stocks only in red shows a much sharper divergence. It's made a lower low here, a lower low, and a lower low last week. It's trying to move back above its moving average. And of course, that's just based on Monday's strong advanced decline numbers. So this points out how important the end of the week will be. If we continue to move higher as we are Tuesday, as we head in the last couple hours of trading, then it's possible we're going to move back above its moving average and challenge this peak. Last week, early in the week, we were looking for a sharp drop back to the daily Stark bands, which we got last week on Tuesday, had a dramatic rally up. You can see the daily AD lines also show the similar negative divergence, line B and line D. This data is updated as of Tuesday, so the moving average has moved back above its moving average as of about 2 o'clock Eastern time. Stocks only has not been updated, so it's going to take another couple of days of strength for these AD lines to break out to the upside. Is that possible? Of course. Though additional new highs are clearly always possible, you can never say never, never say always, there are a lot of other measures that suggest that the risk is still too high to try to capture maybe 3 to 4% in the upside, as the potential suggests, particularly like if we break this support in here, a decline of more like 5 to 10%. One of the other things I look at is this is the exposure of active managers. You can see it peaked up here about 3 weeks ago, has turned down. Past times you can see it gets down to this 50 level. That's usually a low risk entry point. Was in 2019. 2020, and also, of course, in March of 2020. So this is a trend that suggests that they're not doing a lot of buying and they're more likely to be selling. Below here in red, we have the bullish percentage of the AAII survey. It's also in a clear downtrend. Would like to see it get here below 25 into this 20 to 23 level. That's where it typically bottoms out when you get a good market bottom like we did last fall. Another reason for concern is the number of stocks making new highs and new lows. In a strong market, you see the new highs expanding. They're usually much higher than the new lows. That has not been the case as we head into July and August. You can see it was an uptick in NASDAQ new lows here in the early July. Kept making higher highs. We had a little pullback with a rally phase in early August, and then another surge just a week ago. Well over 300 new lows, and they were just roughly around 80 to 100 new highs in the NASDAQ. So, we need to see new highs expand significantly above the 200 level to suggest that this is improved. That's always possible, but even if that were to occur, this sort of building of new lows suggests the risk in the market is fairly high. Many of you often ask about our special updates. We send those out when things are crazy like they were last week. So this was the update that was sent out on the 17th, suggesting that even though the market had surged sharply to the upside, on the 16th, that this was a rally that was not sustainable. You look down here, this is the closing data from Monday the 16th. Markets were higher, advanced decline numbers were lower and negative, 1,174 up, 2,131 down. Down here, 147 new highs, 80 new lows. NASDAQ, better than 2 to 1 negative there, and look at the new high, new low relationship. So we raised our stops there, took some profits, and, avoided, for the most part, the downdraft that hit us last week. So I think in the next several weeks to the month, getting us through September, we're likely to see a more severe market decline, 5 to 10%. I think given the new highs recently, the SPY and the Qs are looking great. Small caps look horrible, and the broader market does not look that great. So I would feel quite confident in, if you check the levels where we are right now on Tuesday, that stocks will be below those levels in the next 4 to 6 weeks and create a very good and a better risk entry point heading into the end of the year. As always, if you'd like to see some specific advice and get some of the trading lessons that will explain some of these indicators, you can go to Viper Report, click on the Viper ETF and sign up. It's just $34.95 a month, or the Hot Stocks Report. And of course, we do mentoring, a one-on-one training, and that's quite a unique opportunity, and I hope you'll consider it. Well, I hope you have a great week, and we'll either send you a written or a video update after the week closes. Thank you very much.